Greetings and welcome to this week's edition of 401k Real Talk. This is Fred Barstein, contributing editor at wealthmanagement.com's RPA Edge and CEO at Trow, TPSU, and 401k TV. I review all of last week's stories and select the 5 most important and interesting ones, providing open, honest, and candid discussion you will not get anywhere else. So let's get real. First story, job growth remained robust with 253,000 new jobs added in April, which will continue to fuel the war for talent and keep the pressure on the Fed to cool the economy through increased interest rates. Unemployment at 3.4% was down slightly from 3.5% last month, as wages increased 4.4% year over year, but mostly for lower salaried employees. The education and healthcare sectors saw the greatest increase, followed by business services, leisure and hospitality, and government, all accounting for 70% of the growth. Experts are predicting a slowdown by the end of the year, which has already happened in some big tech firms, and indeed job postings tumbled in Q1. Rebounding immigration has helped increase the worker pool. But when the war for talent subsides, it is likely that benefits, especially retirement benefits, will continue to be a key strategy to recruit and retain workers rather than increase wages. Next story, all but 4 states have implemented or are considering a state auto IRA program, with many moving towards a mandate, and Pennsylvania, Rhode Island, Minnesota, and Nevada likely up next. All of which is bound to increase new plan growth in the private sector, but maybe not as quickly as many are projecting, even as industry experts predict that 88% of employers with less than 100 employees will have a plan by 2026, up from 46% prediction according to the most recent Transamerica survey. More states are teaming up as assets in these auto IRA programs have fallen below expectations, and more are being forced to pay vendors or allow them to charge a fee until there is enough money in the plans to subsidize costs, which in a volatile economy or even a recession with many state DB plans underfunded could be very tough. 2 vendors, Ascensus and Bestwell, have been the most active, and both are requiring hard dollar fees, not just basis points. Next story, technology is changing the record keeper and advisor RFP markets in many ways, with firms like InHub, Catalyst, RPAG, InvestNet, and Benetic creating software to streamline the process. But like with robo-advisors, these programs will not replace people, as plan sponsors, even larger ones, need and want guidance from experts. Likewise, technology expertise, along with the ability to educate employees and enough scale to grow with the organizations, are being emphasized in these RFPs, which will further fuel industry consolidation. And while most DC plans with more than 3 million conduct periodic benchmarking and RFPs for their record keeper, just a handful do the same for their advisor or consultant, raising the question of whether advisors should be conducting due diligence on themselves, and whether advisor search consultants should also help plans to find a new record keeper. Next story, Hub International welcomed new investor Leonard Green, providing additional capital as its market valuation soared from $4.4 billion in 2013 when Hellman and Friedman invested and the firm had just $1 billion in revenue to a whopping $23 billion valuation with $3.7 billion in revenue. Acquisitions remain a key growth strategy for Hub, with over 20 in the last 2 years by the Retirement Plan and Wealth Division, as they continue to leverage the convergence of wealth retirement benefits at the workplace, cross-selling services to organizations while providing financial planning to employees. As interest rates rise and borrowing becomes more expensive, it makes sense for Hub to tap new money, as it did in 2018 with Atlas Partners, as well as allow current investors to cash out at least a portion of their investment while increasing the value of their portfolio. Finally, volatile markets and increased interest rates are resulting in record sales of annuities, though not so much in DC plans yet. After a record-breaking year last year, Q1 sales of $92.9 billion were up 47%, according to LIMRA, led by fixed rate and fixed index annuities. Variable annuities were down, and retirement income sales were just $4.1 billion, but the highest of any quarter ever. Along with the disparity in commissions paid to advisors in DC plans, the complexity and technology, as well as lingering fiduciary concerns, are hampering adoption. But the need to provide in-plan retirement income has piqued the interest of many plan sponsors and some advisors as more and more providers enter the market. So those were the most important stories from the last week. I listed a few others I thought were worth reading. Please let me know if I missed anything or if you have any comments. Otherwise, I look forward to speaking with you next week on 401k Real Talk.